One thing that you've got to be aware of when you're using a mortgage calculator online is that the mortgage calculator might tell you that you can afford to borrow quite a lot of money, and that's because you might be using current interest rates. But banks don't work this way. So banks, when they're working out your serviceability, they'll look at what your total lending is at what's called a test rate. So a test rate is a rate that the bank determines as a worst case scenario. So for example, right now, the current 2-year fixed rate with ANZ is about 2.59. However, the rate that they'll test your ability to service at is 5.80. So they use a much higher interest rate. And the other thing that they do is they factor all debt, including investment debt, as if it was principal and interest. So they'll look at your ability to afford that lending based on a higher interest rate and at principal and interest. And then they look at things like your income and the rental income, which they discount by 25%. So they take off a serious amount of money to see that you can comfortably afford the lending. So at worst case scenario, higher interest rates, principal and interest loans at 25% reduced rent, do you still have enough to live? The reason that banks have test rates and scrutiny levels when they're looking at your ability to service is because they don't want to get you into a position where you can no longer afford to own the investment property or your own home. So the last thing a bank wants to do is have to sell a property on your behalf through a mortgagee sale. A lot of times people ask, how come a bank looks at my personal income if the rent is covering all the costs of property ownership when it comes to a rental property? It's a good question. So the reason for this is because banks, using all these things like test rates and discounted rent, work out, again, a worst case scenario. And so what that means is for a $500,000 rental property, for example, getting $500 a week rent, your gross yield in today's market would have to be almost 11%. To be able to meet the bank's criteria and still be neutrally geared. So most properties would be bought under a gross yield of 10%, and so therefore, in the bank's eyes, you need to use some of your income to top up the rental property, even if that's not the actual fact. One of the reasons I think that it's really important to use a mortgage broker is because you've got the best shot at getting an approval for your mortgage straight off the bat. Because if you get a decline from a bank, it can be really hard to get them to change their minds. So by using a mortgage broker, not only do you get access to a range of banks, but you've got the best chance of getting a yes the first time. The reason that brokers have a better chance of getting a yes the first time is because they know what the banks are looking for, not just from a servicing standpoint, but also from an account conduct standpoint, a credit standpoint, whether or not a bank's going to lend a certain amount on a particular type of property, all of these kind of things. And they keep up to date with bank policies as it changes. A mortgage broker will actually look at the application and see whether or not it fits before they submit it to a bank to get an approval. If, on the other hand, a broker thinks that your mortgage won't get approved the first time round, they'll tell you what you need to do to get an approval. Sometimes people will tell me things like they've got a good relationship with a bank and so they don't want to use a mortgage broker because they want to go directly to their personal banker that they've used for years. And whilst I'm big on maintaining good relationships with the bank, you're only getting one set of product offering if you go directly to the bank. It's not like a bank is going to tell you to take your deposit from them and to reduce your risk, go across the road to Kiwi Bank and get the other 80%. So using a mortgage broker gives you impartial advice because you're using someone that doesn't have a tie to any particular bank. One other thing to remember when you're working with a bank directly is often you'll be working with a QFE, which is what's called a qualifying financial entity advisor. Now this person has the bank's products that they've learned, but not necessarily a deeper level of education that goes around giving financial advice. And often when you use a mortgage broker, you'll have at the moment what's called an RFA or an AFA, and that's changing in the future. And this means that this person's gone through a higher level of qualification and can give you financial advice that's personalised to you. Mortgage structure is quite a broad term that we use for different loan types and also different ways that you might own an investment property or borrowers for a loan. So for example, you might go interest only or principal and interest, you might be fixed or floating, you could have a revolving credit or an offset loan. So there are different things that different banks offer in different ways. So again, this is where using someone like a mortgage broker, they can explain how the different products work and tell you that, for example, offset loans are only available with Kiwibank, Westpac and BNZ, whereas if you go to another bank, you might have to use a revolving credit which operates in a different way. There are three main benefits to getting your structure right. The first is asset protection. So by using a correct structure, you can often limit the amount of exposure to your own home, for example. The next is cost savings. So by having a good structure, you can limit the amount of interest that you pay or save some money in interest and or in tax savings later on. And then the third is potentially being able to borrow more by spreading your loans at different banks. There are three major things that a bank is going to look at when assessing your application. The first one is around cash flow. So they want to know how much money is left over after all of your new loans are in place. And often that's called UMI, which is uncommitted monthly income. So in their worksheet, they'll look at what income's coming in, and then what expenses are going out and what's left over. That's your UMI. So they want to know that you can comfortably live even after all your expenses are paid. The second thing they look at is what's called LVR. So that's loan to value ratio. Now this is how much equity you've got in your house. Different properties have different max LVRs. So for example, an apartment, depending on the size, you might only lend 60% on that. Compare that to a house, you might be able to lend 80% or maybe 90% if it's an owner-occupier. So they look at their ability to recover their money in the event that you stop paying it and they have to sell. The third thing they look at is the person themselves. They look at the character. And so they look at things like your bank statements to see how you manage your money. And they look at things like your credit check to see that in the past you've paid back any debts. Now, when the bank's looking at expenses, some of the things that they take into consideration is your existing loans at the existing term, but at the current servicing test rate. So even if you're fixed at 2.5%, they're going to use the current 5.8, for example, test rate, and at the 25 term that you're paying it on. Then they'll look at things like your new lending at 30-year P&I term, even if it's going to be interest only, and again at that servicing test rate. Then they'll look at things like credit cards. So if you've got a credit card limit of 20K but you pay it in full every month, they'll still assess as if you've borrowed that full $20,000. The same applies for overdraft limits or revolving credit facilities. And then when they're looking at your expenses that you pay out as a household, they've got a rule, generally speaking, of what 2 adults, 2 kids, and 2 cars cost. And if your declared expenses are less than that, they'll use their figure. If they're greater, they'll use your figure. Sometimes people can get a little bit frustrated because even though they can afford a new loan, the bank won't allow them based on their servicing worksheets. And so sometimes banks can be criticised. But remember, the last thing a bank wants to do is put you in a position where you're forced to sell an investment property or your own house, or even worse, for them to be in a position where they're forced to. So they have these rules in place to make sure that you don't overcommit yourself. But what this means is if you get an approval from the bank, you can have confidence that you absolutely can afford it. Next, I want to give you an example of what real life looks like compared to what the bank looks like when they look at it through their servicing workbook. In real life, let's take an example of a property worth $500,000 that gets $500 a week rent. Now, if you borrow 100%, so $500,000, and you fix at 3% and have an interest-only loan, which is very common for an investment property, then your mortgage payments are $15,000 per annum. Now, operating expenses in this example, I've worked on 40% of the rent received, which is $10,400. So total expenses work out to be $25,400 and the total income $26,000. So therefore, the annual cash flow is positively geared by $600, which means $11.54 per week
positive income. Now, let's look at it as if a bank were. So they take the $500,000 property and the $500 a week, and with the rent, they discount it by 25%. So their expenses that they factor in are less than mine because they just look at rates and insurance. They're not looking at things like vacancy and maintenance and accounting, for example. So their operating expenses are $6,500, but the mortgage is much higher because they work on a principal and interest loan. They work on a 7% test rate, for example. So that's $40,000 of mortgage payments compared to the $15,000 interest payments that I worked out. Based on the bank's servicing, you've got total expenses of $46,793, which means an annual cash flow loss of $20,793, which means almost $400 a week top up required when the bank's looking at this from a servicing worksheet. Now, just to clarify, this is what the bank's looking at a worst case scenario. Just because the servicing workbook shows negative $400 a week doesn't mean you actually have to pay it. Remember, this is real life. And so this property is cash flow positive. It just requires a top up from the bank's servicing worksheet. So again, you don't need to be worried whether or not you're saving $400 a week currently. The bank just wants to know that you've got the ability to afford this loan at a worst case scenario. They're not actually looking at whether or not you're saving $400 a week at the moment. There are two main ways that you can improve your UMI or uncommitted monthly income. The first is increasing your actual income. So you can do this by asking for a raise, for example, or changing jobs to get a higher income. You can do things like reduce your voluntary super and payments. So if you've got KiwiSaver, you do have the ability to opt out if that's the right thing for you, and therefore it increases the amount that hits your actual account. You can look to increase your rents. So things like this will improve the credit side of things. On the debit side of things, your expenses, you can look to reduce some of those costs like credit cards. For example, as I mentioned before, banks look at the full credit card limit. So if you've got a $20K unused limit, you could look at reducing or closing that if you don't need that facility. If you've got short-term debts, you might roll them into your personal mortgage. And if your personal mortgage is on a really short term, you might look at extending that, but keeping the repayments the same. So you still pay off your loan in the current time frame, but your loan term, the minimum payments, will change so that it allows you to look at it from a different perspective there. Now, I want to give an example of how restructuring your personal mortgage can improve your UMI. Let's look at someone with a mortgage of $300,000 who has 10 years left on their remaining loan term, fixed at say 3%. Now the bank will look at this based on their test rate, we'll call it 7%, and that loan term of 10 years. So the bank assessed repayments is $820 a week, even though in actual fact this person would be paying $145 less per week because of their interest rate being actually 3%. Now, if that person were to extend the mortgage term out to 30 years, for example, that brings back their committed monthly payments down to $465 a week. So it saves $356 a week in the bank's eyes. You can actually continue to pay the same amount and pay that loan off in the same 10-year period just by using things like a revolving credit facility. So you make the same payments, you just do it at an extended loan term so that your uncommitted monthly income improves by a drastic amount, $356 per week. So the interesting part here is by restructuring that debt, you've almost got enough money to service that $400 that we used in the last example per week to buy that investment property. So even if someone had a negative UMI, they can increase this to a point where a bank is happy with the application by making a few small changes like this. Now let's use that same example again, but let's look at someone that might also have a higher purchase. So let's work on a higher purchase of $16,000 and might be interest-free, with payments of $100 a week over a 3-year term. Now, in this instance, if we need to improve the UMI, what we might do is we might add $16,000 onto the personal mortgage, bringing it up to $316,000. We might pay off the hire purchases. So we get rid of that $100 a week commitment that's going out. But by doing this, obviously your personal mortgages go up. And so the payments go up by $23 a week, but you're saving $77 because you've reduced the $100 payment that was going out. So your UMI has improved by $77 a week. Now the next thing again that will come up is I don't want to pay off my hire purchase over 30 years, which is a fair point. And also a lot of hire purchases nowadays are interest-free for a period of time. Now you do have to look at the bigger picture. You can still make again those same payments to pay off that hire purchase over a shorter period of time, and you might pay a little bit of interest by adding it onto your mortgage. But if it's the difference between being able to invest and not being able to invest, then I think being able to invest is the better option. Sometimes this can feel a little bit like you're just trying to trick the bank to give you an approval, and that's not the case. What we're saying here is we're going to reduce your outgoings for a worst case scenario. So if in the event of a high interest rate, your minimum payment that you have to make on your mortgage or your hire purchases is less than now. So it gives you flexibility. So this just means that you've got a good safety net as a worst case scenario. The other two things that a bank's looking at are your credit checks and your account conduct. So let's talk about credit checks first of all. A bank's going to look at what you've applied for in the past, so they'll look at the number of inquiries that have been made on your credit report, whether or not those loans have been approved, and then they're going to look at whether or not you've had any defaults. So have you been in a situation where you haven't made your credit card payments and now it's gone to a debt collection agency, or something like a hire purchase. So they want to know what historically you've been like with making payments. The other thing is your account conduct. So they will look at your bank statements for the last 3 to 6 months, and they're going to look at things like undisclosed debts. So do you have credit cards that you haven't put into your application? Do you have hire purchases that you haven't told them about? They'll look at your expenses, so they'll see whether or not the amounts that you've told them are realistic. So if you've got a whole lot of money going out to bars and restaurants and you've said that you live on $100 a week for food, they're probably going to question those expenses, and they're going to look at anomalies. So an example that I give sometimes is people who take money out at a pub and they take out $45 and it's $5 for a drink and $40 for the pokies. So things like this are alarming to banks. So things in your bank statements really count when the bank's looking at whether or not they're going to lend you some money to invest